Welcome to the Deep Dive, where we really get into the important details from the latest reports and calls.
Helping you cut through the noise.
Exactly. Today, we're digging into Delek Logistics Partners Q2 2025 earnings call, DKL, ticker symbol DKL.
And this one's interesting because the market reaction seemed, well, a bit subdued, maybe even slightly negative after the release.
Right, down about 2.4% on the day on higher volume too. It feels like maybe the market just saw the headline misses and didn't quite look deeper.
Which suggests there's more to the story here for, investors who are really watching the space. We need to unpack what's really going on.
Okay, let's start with that snapshot then, the Q2 results.
Go for it.
So GAAP EPS was 183 cents per unit. That unfortunately missed the consensus of 0.87 cents.
Okay, a slight miss there.
And revenue also came in a bit under expectations, $246.35 million versus a consensus around $256 million. That's actually down about 6.9% year over year.
So those are the numbers that probably caught the market's eye initially, the misses.
I think so. But here's the other side of the coin. Adjusted EBITDA hit a record. $120.9 million.
Wow, record EBITDA. How much up was that?
An impressive 18% jump compared to last year.
Okay, that's a significant number. Record EBITDA despite the revenue dip.
Yeah, and distributable cash flow, the DCF as they adjust it, came in at $72.5 million. That gave them a pretty healthy 1.22 times coverage ratio.
So covering the distribution comfortably.
Comfortably. And speaking of the distribution, this was a big one. Their 50th consecutive quarterly increase.
50 straight hikes. That's quite a track record.
Took it up to 1.114 per unit. So you see this contrast, right? Headline misses, but record EBITDA, strong coverage, and another distribution hike.
Definitely. And that market reaction, we mentioned that pre-market dip of 2.1%, closing down 2.4%. The volume spiked to around 153,000 shares.
Which is way above average for them.
Exactly. It really points towards investors maybe focusing too much on that EPS and revenue miss, perhaps overlooking the operational strength shown by that record, Adjusted EBITDA.
It happens. Sometimes the algorithm or just the quick scan misses the underlying story.
Right. And for people looking closely at MLPs, this kind of disconnect where solid operational results don't immediately translate to stock performance can be, well, an area to watch.
Okay, so let's unpack this call then. Let's really get into the specifics of DKL's performance and their strategy.
Sounds good. Where do you want to start? Financial breakdown.
Yeah, let's look at the segments. Gathering and processing, the G&P segment, saw Adjusted EBITDA jump significantly. It went to $78 million.
Up from, what, about $55 million last year?
Exactly. And management pointed directly to the acquisitions they made, H2O Midstream and Gravity Water Midstream, as the primary drivers for that boost.
So they're successfully integrating those water assets, and it's showing up in the numbers already. That's a good sign for execution.
Definitely seems like it. Now, on the other side, wholesale marketing and terminating Adjusted EBITDA actually decreased. It was $23 million this quarter, down from $30 million a year ago.
Okay. What was the reason given for that drop?
They mentioned amended and extended agreements with their parent company, DK, that went into effect last summer.
So potentially a structural change in those agreements affecting the comparison.
Well,
maybe more about long-term stability than a segment decline.
That seemed to be the implication, trading some short-term upside for maybe more predictability down the road.
Makes sense. And the other segments?
Storage and transportation Adjusted EBITDA was pretty much flat, held steady at $17 million.
Okay, stability there.
And their investments in pipeline joint ventures segment chipped in positively. They specifically mentioned the contribution from the Wink to Webster or W2W pipeline interest that they got via dropdown back in August 2023.
Right, that W2W dropdown adding stable cash flow.
Yeah.
And you mentioned parent company DK. Just quickly, for anyone maybe less familiar, can you touch on what a dropdown means in this MLP context?
Sure. Yeah, a dropdown is basically when the parent company, Delek US Holdings here, sells an asset like a pipeline share or a terminal down to its MLP, Delek Logistics.
And the benefit for DKL.
It gives DKL more assets generating steady, often fee-based cash flow, helps it grow its distribution base, and it shows the parent is committed to supporting the MLP. It's a common tool in this space.
Got it. Thanks. And what about spending, capital expenditures?
CapEx for the quarter was about $119 million, but the vast majority of that, $115 million, was earmarked as growth CapEx.
Heavy on the growth side. Any specific projects called out?
Yes, a big piece of that growth spend, around $48 million, went toward a Libby 2 gas processing plant.
Libby too. That brings us neatly into the operational highlights and their Permian strategy. This feels like a really core part of their story right now.
Absolutely. Here's where it gets really interesting. They successfully completed and commissioned that Libby 2 gas plant. It's online now.
Huge milestone. And what's the ramp-up plan?
They expect it to reach full capacity during the second half of this year, 2025.
So meaningful contributions starting soon. What does Libby 2 fundamentally change for them?
It significantly boosts their gas processing capacity in the Delaware Basin, which is, prime Permian territory. More capacity means more producer volume, more fee income.
And they're not stopping at just basic processing, are they? I thought I saw something about sour gas.
Exactly right. They're really focused now on advancing their sour gas treating capabilities, plus gathering, and importantly, acid gas injection, AGI, at that whole Libby complex.
Okay, let's pause there. Sour gas treating and AGI. Why is that so important in the Delaware Basin right now? What edge does that give DKL?
Well, sour gas, which contains hydrogen sulfide, needs special handling. It's corrosive, it's toxic. AGI is about safely injecting that removed acid gas deep underground.
So it's an environmental and operational necessity.
Absolutely. And having robust AGI capacity is becoming a real differentiator. Producers are increasingly looking for midstream partners who can handle the sour gas streams responsibly and efficiently, especially as regulations tighten.
So it basically makes DKL a more attractive partner for producers in those areas with sour gas, a competitive advantage.
Precisely. It strengthens their overall service offering. And speaking of offerings, they're also pushing ahead on the water side.
Right, the H2O midstream and gravity water midstream acquisitions. How's the integration going?
They said it's progressing well. Integrating these systems expands their water gathering footprint significantly across both the Midland and Delaware basins.
And water is just critical out there.
Yeah.
Managing produced water is a huge operational factor for producers.
No doubt. So having a larger integrated water system makes them more of a one-stop shop. Plus, they noted that crude gathering volumes are picking up too.
On both systems, Delaware and Midland.
Yep, both the DDG in the Delaware and the DPG in the Midland are seeing volumes increase starting this quarter, Q3, and they expect that trend to continue.
That suggests healthy activity from their producer customers.
It does, and management really emphasized this point. They now have this unique, comprehensive system in the Delaware Basin handling all three streams: crude, gas, and water.
That three-stream capability, why is that particularly powerful beyond just offering more services?
Well, think about diversification. In a volatile commodity world, they're not just reliant on crude volumes or gas volumes.
Right. If gas prices slump, they still have crude and water flows. It provides a base level of stability.
Exactly. It de-risks their business model compared to maybe a pure play gas gatherer or a crude pipeline operator. It makes their overall cash flow potentially more resilient.
Building the complete infrastructure network, not just one piece of it.
That's a good way to put it. So operationally, things seem to be moving in the right direction, executing on these big projects. What about the balance sheet to support all this?
Yeah, how are they funding this growth? And what does their financial flexibility look like?
Well, they made a pretty significant move there, too. They priced and closed a big debt offering, $700 million in senior notes due out in 2033.
$700 million. That certainly boosts their liquidity.
Massively. They said it pushes their total liquidity to over $1 billion.
$1 billion in liquidity. That's substantial dry powder.
Gives them a lot of flexibility, right? For more organic growth projects, maybe some smaller bolt-on acquisitions if the right opportunities come along.
And in this higher interest rate environment, having that cash on hand or accessible is a big advantage. It means they can be selective and act strategically.
Plus, it extends their debt maturity profile. Locks in a rate on that chunk of debt for quite a while. What about leverage?
Leverage is sitting around 4.32 times, which, for an MLP generating this kind of cash flow is generally seen as manageable, gives them room to maneuver.
Okay, so strong operations, boosted liquidity. This leads to the outlook, the guidance. How are they feeling about the rest of 2025?
This was another key point from the call. They reaffirmed their full year 2025 Adjusted EBITDA guidance, still targeting $480 million to $520 million.
They didn't lower it because we've seen some other midstream players trim their outlooks recently.
Exactly. Not only did they reaffirm, but they explicitly stated they are increasingly confident in hitting that range.
Increasingly confident. That's a strong choice of words when peers might be getting cautious.
It is. It signals real conviction in their strategy and the contribution from these new projects, like Libby 2 ramping up.
And what about cash flow coverage?
They expect the DCF coverage ratio, that 1.22x we saw this quarter, to actually continue rising through the rest of the year as those growth projects contribute more cash flow.
Makes sense. Did they comment on the commodity price environment? WTI crude has been a bit volatile, hovering, say, around the $65, $75 range lately.
Like they did. They highlighted their strong relationships with producers who are operating in core Permian areas with low break-even costs.
Meaning those producers can still drill profitably even if prices aren't super high.
Right. They feel this provides a good degree of stability for their volumes, even if WTI is maybe around $65 or so. Less sensitive to the swings, perhaps.
That confidence, especially relative to peers, is interesting. But surely there are risks, right? What if producers do pull back drilling or Libby 2 ramp up hits a snag?
Oh, absolutely. No guidance is guaranteed. A sharp, sustained downturn in commodity prices could eventually impact even low-cost producers. Operational hiccups are always possible with new facilities.
And regulatory changes, maybe?
That's always a background factor in this industry.
Yeah.
So yes, while management sounds confident, investors still need to weigh those potential headwinds.
Okay, stepping back, let's connect this to the bigger picture for investors looking at DKL within the whole midstream MLP universe.
Right. So midstream MLPs, especially those heavily tied to Permian volumes like DKL, they tend to be sensitive to interest rates. That's just a given.
Sure, affects yield expectations and cost of capital.
And the recent drivers for DKL stock seem pretty clear, even if the immediate reaction to Q2 is muted. You've got those serial distribution hikes. 50 is a big psychological number.
Definitely signals stability in shareholder returns.
You've got the successful $700 million debt deal strengthening the balance sheet. You've got the Gravity Water acquisition closing and integrating, and Libby 2 coming online. Those are tangible catalysts.
So despite the market maybe keying in on the Q2 top-line misses,
management was really focused on hammering home the operational progress and the growth trajectory. It's that classic story versus headline tension.
what were analysts pressing them on during the Q&A?
A lot of focus, naturally, on the Libby 2 ramp-up timeline and potential for further expansions there. Also, that competitive landscape for sour gas treating in the Delaware, how crowded is it getting?
We talked about why that capability is important. Is it becoming a bottleneck, or is DKL well-positioned?
It seems DKL feels their early investment and integrated approach gives them an edge. But yes, as more sour gas comes online, treating capacity will be crucial region-wide.
Yeah.
Analysts are definitely probing that.
What else? M&A, producer plans.
Yes, questions around M&A strategy. How disciplined will they be, and how are their producer customers thinking about drilling plans given price volatility? Standard but important questions.
And on M&A, they have pretty strict criteria, right? Has to be accretive, improve leverage, boost coverage.
Very disciplined. Free cash flow accretive, improves leverage, enhances coverage, fits strategically. That's a high bar, especially with current capital costs.
Does that make finding deals harder now?
It certainly does. It means they're likely being very selective, which is probably prudent. They also made a point of saying they're not married to an asset, meaning they're open to potentially selling assets too, not just buying, if it makes sense for optimizing the portfolio and creating value. It signals flexibility.
Okay, so looking ahead, what are the key things investors should watch for? The main catalysts.
Definitely the continued ramp up and eventual full contribution from the Libby complex, including those sour gas upgrades. That's number one.
More volume, more fees.
Exactly. Also, watch for new contracts or wins stemming from those expanded water systems, Gravity and H2O. Are they leveraging that bigger footprint?
Okay.
Obviously, continued quarterly distribution increases are a key signal investors watch closely in MLPs.
The streak continues.
That's the expectation they've set. And finally, any further financing activity or maybe another drop down from DK could potentially boost results or provide capital for growth.
All right, lots to track there. Now let's pivot to our not financial advice segment. Given everything we've discussed, what's a potential trade idea an investment committee might chew on?
Okay, keeping in mind this is purely hypothetical.
Wild but plausible.
Right. How about this? Consider initiating a long position in Delek Logistics Partners, DKL.
Okay, straightforward, long.
But pair it with a short position in a carefully selected basket of other midstream players, specifically ones that are maybe higher leveraged, less diversified, perhaps pulled back their guidance recently, or are showing weaker DCF coverage.
Ah, a pairs trade. Long DKL, short a basket of weaker peers. What's the core thesis behind that?
The thesis is essentially a quality spread trade within the midstream sector. You're betting that DKL, with its billion-dollar liquidity cushion, its strategic Permian build-out like Libby 2 and the integrated water, and that proven commitment to the distribution,
The 50 hikes.
is just fundamentally better positioned to capture Permian volumes and navigate the current environment than some of its peers.
And the short side?
The short side targets those companies that might be struggling more with higher capital costs, maybe have less resilient cash flows, or are facing more operational headwinds. You're betting on divergence.
So you capitalize on DKL's operational strengths and financial prudence while hedging against sector-wide risks by shorting perceived weaker players.
Precisely. DKL's consistent distribution record provides a sort of downside cushion or floor for investor confidence, while the growth projects offer upside. The weaker peers might lack both. It's betting on increasing differentiation in the sector.
Interesting. A quality play expressed as a pairs trade.
Okay.
Definitely something to think about.
Again, just an idea, not advice.
Absolutely. So let's wrap up this deep dive on DKL's Q2. What's the key takeaway?
I think it's that mixed headline picture, the EPS revenue miss, really masked some significant underlying strengths.
Record Adjusted EBITDA, the 50th distribution hike, strong liquidity, reaffirm guidance with confidence.
And real progress on major strategic initiatives in the Permian, especially Libby 2 and the integrated water systems. Management seems confident, and operationally, they appear to be executing.
The market's initial reaction might have been a bit short-sighted, perhaps?
It seems possible. That emphasis they put on the comprehensive three-stream system, crude, gas, water, that feels like a key differentiator. It offers resilience.
A more robust model for the competitive Permian landscape.
That seems to be the core value proposition they're building.
All right. Well, remember, everyone, the information discussed here today is purely for educational purposes. It is definitely not financial advice.
Please always do your own thorough research and due diligence before making any investment decisions.
Thanks for tuning into the deep dive. We value your feedback, so let us know what you think.
Join us next time for another look beneath the surface.